The US is already in a recession, or it's coming. Well, at least that's what all the media headlines tell you. It's pretty scary. Almost every media headline out there is calling out the R word. So just over the last 1 week, you can take a look on CNBC. Critical economic reports Wednesday show how close the US is to a recession. Trump trade war update. Firm predicts empty shelves and recession by June. America is dangerously close to the worst kind of recession. Dow tanks 200 points as US economy shrinks. Recession fears loom. So is it time for us investors to run for the hills, to sell all our stock, or is it time to just hold on to great stocks and keep on buying? Let's find out in this video. Yesterday, the US stock markets initially opened very low because of this report that the Q1 preliminary GDP came in negative. Oh my God, it's negative 0.3%. We're gonna die. Okay. And of course, that sparked even more fears of a recession, because how do you define a recession? A recession is defined as 2 quarters of negative GDP. And of course, the media always likes to play up the fears. That's how they get engagement, right? But again, you have to always dig into the numbers and see, okay, is this really something to be concerned about? So first and foremost, you have to understand how is GDP calculated. It's calculated based on imports, exports, consumer spending, business investments, and they calculate GDP. So one of the reasons why GDP was negative in Q1 was because it was heavily influenced by a record surge in imports in the first quarter, which grew at an annualized rate of 41.3%. So what happens is that when a country exports, it's positive for GDP. When they import, it is negative. So in Q1, there was a sudden 41% increase in imports into the US. Why do you think so? Right? Because a lot of companies were front running the tariffs. They want to import in before the tariffs hit. So you got a lot of imports coming in Q1. So that created a big negative. In fact, that surge in imports contributed to a negative 5 percentage points drop to the GDP. So that's the reason why. So this import spike was again attributed to the businesses front-loading goods to avoid anticipated tariffs imposed by the Trump administration. So this surge in imports is what we call an outlier. It is an anomaly. It will not recur, right? So if you actually reduce or remove this import surge as a one-time response to tariff expectations, excluding the import drag, GDP growth for Q1 would actually be 3%, right? And supported by strong consumer spending that came in 1.8% and strong business investments that surged 21.9%. But once markets realized this, it reversed by the end of the day to close higher. And not only that, but there was also very positive news coming out from inflation data as well as consumer spending data. So yesterday you can see that the core PCE data, which measures inflation, which is what the Federal Reserve looks at, core PCE year-on-year came in at 2.6%, which is as expected, which was 2.6%. If you look at this chart over here, you can see core PCE year-on-year continues to decline. So inflation continues to moderate despite the concern and the fears that tariffs would inflame inflation. Of course, it could happen, but for now, the data shows that, all right, inflation is going as expected. Now, at the same time, you can see real consumer spending, which accounts for inflation, grew at 0.7%, which is better than expected. So this positive news helped to reverse markets higher by the end of the day. After the market closed, you can see that the futures data shows that the market is probably going to surge even higher. So reason why is because of very strong earnings from Meta platforms as well as Microsoft, which are two of the biggest positions in my portfolio. And Alphabet also announced pretty good results. So all in all, we are in the earnings season, and companies that have reported so far have reported better than expected earnings. So you can see that the companies that have reported so far have reported a year-on-year earnings growth of 10.1% for the first quarter of this year. And this is above what analysts expected, which was 7.2% earnings growth. Profit margins have also come in pretty strong. S&P 500 companies reporting showed a net profit margin above 12% for the fourth straight quarter, for quarter 1 2025. And higher net profit margins are expected for the rest of the year. And that is why the market has been so bullish and going up for the last couple of days. So of course, if you had listened to Bank of America, and by the way, I showed this in my last YouTube video, right? Where a lot of people say, oh, short the S&P 500. And on the 11th of April, these analysts and big banks, they said, short the S&P 500, we're going to die. And if you listen to them, you'll be screwed as usual. So pro tip, right? Just go opposite of what all these experts in the media say, and you do pretty well. I'm sure many of you would ask this million-dollar question, has the market bottomed? Are we going back to all-time highs? So first and foremost, some of the media would say that we're in a bear market. Now, first of all, that is absolute rubbish, because a bear market is defined as price closing 20% below the high of the market. So we came very close to a bear market. If you recall, the market dropped 20% on this day, but did not close 20% below the high. It closed above 20%. So technically, we are not in a bear market. We are in a correction. Yeah, so just bear that in mind. So again, the question is has this correction bottomed? Now, I wish I could tell you 100% yes, but no one can predict 100% because there are too many moving parts. I can't predict what Trump or Xi or Putin will say the next week. They say some crazy shit. Of course, the market can drop even lower to a new bottom. But ceteris paribus, everything else remaining equal, barring any other crazy shit that they say, which I can't predict, based on technical analysis, based on price action, it looks like the market has bottomed. So I would give like a 70% probability the market has bottomed and is going higher from here. Of course, not in a straight line, but through ups and downs. So why do I say the market is bottomed? Well, if you watch my last 2 YouTube videos, I gave you some reasons why I thought the market was bottoming. One was the Williams percentage R being oversold, as well as the VIX going above 60 and below 35. Those were indications of a market bottom. And I'll run through that again. But let me just go a bit more into the charts of the S&P 500. So first of all, you can see that during this correction, that was the high of the market, right? And then we've got a correction, we've got a wave down there, a wave up, wave down, wave up, wave down, wave up, wave down. So this is a downtrend pattern, making lower highs and lower lows. And you will notice that this line over here is what we call a trend line resistance. So many of the traders were watching this trend line resistance to see, can it be broken? Because oftentimes when the market rallies in a correction, hits the trend line resistance and fails, right? So what happened in the last few days has been pretty constructive. So you can see that on this day, what happened? Yeah, so the S&P managed to close above the trend line, which is no big deal. Sometimes it could be a breakout failure. It closes above and then comes back below, right? But since then, you can see the market has has spent 4 days above this trend line, which is a very bullish development. Now, at the same time, you can see that this level here, 5,000, about 5,005. Yeah, 5,005 is a pretty significant level because this was a previous support that could become potential resistance. So many traders were watching this level, this 5,005 level. And so the market managed to also break above and close above this level over here. And we are also above the 20 exponential moving average, the red line. So that is also showing us short-term market momentum is bullish. Yesterday, when the market opened, it looked initially like it was going to be a breakout failure because the market initially kind of like opened here and then it went all the way down. Looked like it was going to break back below that trend line. But again, because of the strong inflation data, the strong consumer spending data, and the fact that GDP was not as bad as what people thought, the market managed to close back above that level. So again, that's a very bullish signal, very constructive signal. Now, I also said, if you recall in my last YouTube video, that if you look at the weekly candles, it also showed signs of a bottom. In fact, about 2 weeks ago, 2-3 weeks ago. Why? Because you can see what is known as a bear trap pattern, or like what Elson Chu, my buddy who teaches price action manipulation, calls a false bottom pattern, which is a very powerful bullish pattern. So a false bottom or bear trap is when you have got a major swing low and then you have another second swing low that forces the first swing low. Because at this swing low, a lot of traders place their stop loss below the swing low. And so what market makers do is they force the price down to hit the stop losses, causing retail traders to sell, market makers pick up the stock and then run the market up. That's how they manipulate the market to collect stop losses. So this is a classic double bottom bear trap pattern. So once you got a double bottom and the market closes with a very strong candle, so we had a very strong bullish candle that closed back above this swing low, that was a very powerful reversal pattern on the weekly charts. And I did cover this in my last YouTube video, or was it the one before that? Either one of them, right? So this has been a bullish signal as well. And I also mentioned, if you recall, if you take a look at the oversold signals on the Williams percentage R. So whenever the Williams R52 and Williams R13, they both go below this dotted line, which is minus 80, right? Below minus 80, below minus 80, that is a potential bottom. Again, not 100%, but potential bottom. Same thing here, below minus 80, below minus 80, potential bottom, right? Below minus 80, below minus 80, below minus 80, potential bottom, okay? So every time it does that, it's a potential bottom. Now, like I said, it doesn't mean it is the absolute bottom. It could still make a double bottom. It could make a double bottom, but it is a potential bottom. Now, of course, the next level of resistance a lot of people will be watching would be this level here, about 5648. Why? Because this is a 61.8% Fibonacci retracement level. So you can see that if you take this as the A to B wave, right? So A, B to C, this is a 61.8% Fibonacci retracement. So some people could say this could be the part of a larger downtrend, which of course everything is possible. So this is the next level we'll be watching, the 61.8% Fibonacci retracement level, which is at 5648. So you can bet that once the market reaches this level, you would see some kind of resistance, right? The market could go up there, find resistance, it could bounce a bit, but if it can break above this and close strongly above that for at least 3 to 5 days, we are pretty much home free back to all-time highs by the end of the year. Will that happen? I don't know. I'll be watching that level pretty closely. Some people would ask, what if this really turns out to be a recession? What if tariffs remain high enough that it kills demand for goods and services, or shelves remain empty and we get into a recession? Could that happen? The answer is, of course it could happen. But you know something? There's no way to predict it. And if you can't predict something and you have no control over something, there's no point worrying about it and letting it affect your investment decisions. You see, over the years, I've learned that even the top economists in the world who look at macroeconomic data, they can't even predict a recession. So what makes you think that you can or I can? No, we can't. So a good example was back in 2023, where almost every economist said a recession was inevitable. In fact, in late 2022, early 2023, you could see a lot of the news headlines. The Economist magazine said, why a global recession is inevitable in 2023. They say it's a 100% chance of a recession, not 99%, 100% chance. And then the stock market will fall 25% when the looming US recession hits in mid-2023, said Deutsche Bank. This was again late 2022. And in early 2023, the International Monetary Fund, IMF chief, warns of a very tough year for the world economy. That was early 2023. So if, again, you read all these macroeconomic news and thought, oh my God, it's a recession, I'm going to sell everything, get out of the markets, what would have happened? Well, you would have missed out tremendous gains in your investments. Why? Because number one, there was no recession. And number two, what happened in 2023? Well, the stock market gained 25%, one of the best returns in history. That is why Warren Buffett has always said that he himself, he never pays attention to the macroeconomics. He only looks at it for entertainment, but he never factors it into his investment buy and sell decisions. Why? Because he said that the economy is important, but it is totally unpredictable. Once again, even the top economists can't predict the recession. What makes you think you can? What makes you think I can? None of us can. Here's another very good example. In December 2022, Fortune said this top economist, Mohammed El-Arian, says we can't avoid a recession. We can't avoid a recession. Now, 4 months later, that same guy, Mohammed El-Arian, but this time they didn't call him a top economist anymore. They renamed him as Alliance Advisor. But it's the same guy. I mean, I thought he was his evil twin, but it's the same guy. And what he said on the 10th of April, he said, I think we can avoid a recession. So again, even these top economists, we're going to have a recession. No, we're not. Yeah, we are. No, we're not. So why even bother trying to predict a recession when these guys can't even do it? And the other reason why we shouldn't bother about macroeconomic data, or even if a recession is declared, is because remember this, the stock market is not the economy. The stock market is not the economy. The economy can go to crap, the market can still go up. That's what happened in 2020. So the stock market doesn't reflect what is happening to the economy now. The market reflects where it thinks the economy will go in the future. So in other words, the stock market is always a leading indicator of the economy by 6 to 12 months. And here's the interesting thing. By the time a recession is declared, that we're in a recession, it is usually 6 to 12 months after the recession already started. So in other words, by the time a recession is officially declared, the recession is almost over. So why even bother looking at all these macroeconomic data? It doesn't help you in your investment decisions. So look back at 2020 during the COVID recession. Market crashed and made a bottom on the 22nd of March. And if you read all the news headlines, once again, they were all very, very pessimistic. They said that the worst isn't here yet. It's going to get worse. It's a bear market. It's going to collapse. A bear market is going to collapse. Right? All the negativity, right? Then, on the 19th of July, which is here, the NBER, which is the National Bureau for Economic Research, officially said the US has entered a recession. Now, what do you think most people do when they read the headline? We have entered a recession. Oh my God, let's sell everything, right? But by the time they announced the recession was already almost over. And the stock market had already gone up 48% by that time. And if you had sold there thinking, oh my God, a recession has been declared, you would have gotten out just before the next big bull run in the market that took it another double-digit returns, right? And you can see that people always say, I want to invest when it's safe, when the media says that there's no more problems, when there's no more recession. Here's the trouble. By the time you buy when it is safe, you're buying when all the companies are overpriced again. You're buying it when it's already too late, in a way, right? You missed the bottom. So for example, it was only on the 7th of February that the media turned positive and they said the stock market is bouncing back for the right reasons. And by the time they announced that, the market had already gone up 70% from the low. Instead of trying to predict whether there will be a recession, instead of doing that, focus on building a portfolio of the highest quality businesses that are the most resilient. So even if a recession hits, your businesses will continue to do well. They will continue to grow their revenue, their profits, and cash flow. If short-term pessimism causes their stock price to drop below the intrinsic value, use it as an opportunity to increase your stake in these great businesses, where over time, they will keep increasing in value and compound your wealth. So how would you know which stocks are resilient even in a recession? Well, very simple. Look at the last recession and look at which businesses continue to grow their revenue and profits even in the recession. So these are companies where people have to use the products, people have to use the services even in a recession. And ideally, you want companies that have what we call recurring income, that people still got to pay for it, whether is it rain or shine. So let me give you 5 examples right now. The first would be Microsoft that just reported earnings yesterday, blowout earnings. So of course the price is gapping up. But if you take a look at Microsoft, ticker symbol MSFT, look at what happened during the 2020 crash or 2020 recession, right? And you can see this was 2020. What happened? Their sales revenue in blue still went up because people still had to work from home, work in office. They got to still use Microsoft. You got to still pay for your Microsoft subscription, right? So revenue went up, profit went up. We call this a resilient business. But of course, you only want to add more if it is undervalued. So currently, you can see that the intrinsic value for Microsoft is $415, and the current share price is $395. So it is still slightly undervalued, but by today, if the market goes up a lot more after earnings, then of course it could get a bit overvalued. Then you want to wait for it to get undervalued again before looking to add more shares. Here's another example, which would be S&P Global, also one of the bigger stocks in my portfolio. I've held this for many years. And S&P Global, they are doing a lot of the ratings and financial analytics. So again, very recession proof. Why? Take a look at what happened during the last recession. Again, in 2020, what happened? Sales went up, profits went up. So these companies are immune to recessions. These are companies you want to own. So no matter how bad the recession, revenue goes up, profit goes up, zero worries, right? And I bought a lot more of S&P Global about 2-3 weeks ago when the share price dropped. I scooped up more shares. So you have to understand the difference between the business and the stock price. You want to own businesses that keep growing even in a recession. But stock price is affected by manipulation and by news and by sentiment. So when a stock price of a business drops, but the business is doing very well, you don't get worried, you don't get concerned, you take advantage of short-term manipulation and short-term market mispricing. So that's what I did with S&P Global. So again, S&P Global, pretty recession-proof based on how it has responded in past recessions. But right now, is it still cheap? Well, let me put that into my stock oracle, which would, by the way, be launching for a select group of my students next week. And for the broader public, you'll be launched probably in July or August, right? Okay, so intrinsic value of S&P Global is $495. So now it has gone above valuation. So right now, I wouldn't add more, right? So the time to add was a few weeks ago when it dropped all the way down, undervalued, you grab it. Right now, you gotta wait, all right? Again, this is not a recommendation for you to buy or sell. It's just sharing with you for educational purposes and what I own in my portfolio. What else? The other one would be cybersecurity companies like Fortinet. I mean, think about it. If you're a big multinational corporation, you need cybersecurity to protect against hacking and stuff like that, right? Now, even if we get into recession, do you think you'll cancel your cybersecurity services? No, you need it to protect your business. So these are things that companies have to spend on. And again, they pay a recurring subscription. So they lock in the customers and it's more or less recession proof. So once again, you can see Fortinet. How did it perform in the 2020 recession? Revenue still went up. Profit still went up. No worries, mate. And what's the share price right now? Is it overvalued? And how much overvalued is Fortinet? Let's take a look. Yeah, so now Fortinet is back above valuation. All right, so intrinsic value $92. Now it's 103. Now it's above valuation. But again, a couple of weeks ago, it fell all the way to about $80+. That was the time I grabbed more. Many of my students were grabbing more. All right. Another example would be HCA, which is one of the bigger private hospital chains in the US. So as you know, whether it's a recession, if you got to go to the hospital, you got to go to the hospital. It's pretty recession proof. And again, take a look what happened during the 2020 recession. Sales still went up, profits still went up. It's recession proof. And for HCA, let me just double check. I think it is still undervalued if I'm not wrong. I already bought a lot of it. Sorry, it's now overvalued. Okay, so intrinsic value 331. Currently, it is slightly overvalued. So yeah, you have to wait a while for this to get undervalued again. And final example will be Recession. This one is still undervalued. I bought quite a lot of it in the last 3 weeks, and but now I think it's still undervalued. So again, you can see 2020 revenue still went up, profit still went up, very resilient, recurring income in most cases. And if you look at Accenture, which is an IT technology company that will benefit a lot from the AI revolution, you can see intrinsic value 334 and currently still undervalued. So right now in the market, you still have got pretty good businesses that are selling at attractive levels. And for those that are already overvalued, I would be disciplined to wait to only add if we get another sell-off. And again, market doesn't go up in a straight line. There will be ups and downs, and we take advantage of these temporary panics to build our portfolio of resilient companies. Thank you for listening, guys, and may the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.